Assalamualaikum and good day. Today our presentation focuses on comparative analysis of two major retail companies listed on Bursa Malaysia, which are Senheng New Retail and ZAINOL Group Berhad. Both companies operate within Malaysia's consumer retail, but they serve different market segments. Senheng specializes in consumer electronic and home appliance, while Mr. DIY focuses on home improvement and household goods. The objective of the analysis is to compare the financial performance of both companies over the most recent two financial years by examining key financial ratios, including liquidity, profitability, efficiency, solvency, and market performance. Through this comparison, we aim to identify their financial strength and weakness and determine which company performed better from an investor perspective. Senheng was founded in 1989 as a small neighborhood electronics store and has grown into one of Malaysia's leading consumer electronics and home appliance retailer. The company is well known for its fixed price policy and plus one loyalty program, which helps to build long-term customer relationship. Senheng also introduced its premium brand, Senheng, to cater to higher-end technology-driven consumer. Since 2015, Senheng has adopted an omni-channel retail strategy by integrating online platform with physical store. Currently, Senheng operates over 120 stores nationwide and continues to focus on innovation and customer satisfaction. Next is Mr. DIY, was established in 2005 and has expanded rapidly to become one of Malaysia's largest home improvement and household good retailers. The company's success is driven by its focus on affordability, accessibility, and wide variety of products. Offering customers convenient one-stop shopping experience, Mr. DIY operates several sub-brands such as Mr. Top, Mr. Dollar, and Mr. DIY Plus to serve different customer needs. In 2020, Mr. DIY was listed on the main market of Bursa Malaysia, reflecting strong financial performance and investor confidence. Today, with thousands of stores nationwide, Mr. DIY remains a dominant player in Malaysia's home improvement and lifestyle retail industry.
So, right now I will explain about data collection and currency for this study. This research used a quantitative methodology to compare the financial performance of Senheng New Retail Berhad and Mr. DIY Group Berhad for the year 2023 and 2024. A quantitative approach is suitable because of the analysis focus on numerical data from the company's financial statement. The study applies financial ratio analysis to evaluate profitability, liquidity, efficiency, and solvency, allowing an objective comparison between the two companies across the 2 years. This is a purely quantitative study, analyze key financial items such as asset, liability, equity, revenue, and so on. These figures are measurable and variable, which help reduce subjectivity. And all this data used are secondary data obtained from the annual report and audited financial statement of both company, including the statement of profit or loss and the statement of financial position. These resources are reliable, audited, and appropriate for financial performance analysis.
So, for scope of the study focuses on two retail companies in Malaysia over two financial years, 2023 and 2024. Analysis is based solely on published financial data. Non-financial factors such as management strategy, customer satisfaction, and market competition are not included, keeping the study focused on financial performance only. Now, I will present the financial performance of Senheng New Retail Berhad for 2023 and 2024. We will look at revenue, profitability, assets, liabilities, equity, cash, and borrowings to understand the company's financial health. For revenue and profitability, in 2024, Senheng's revenue declined from 1.315 ringgit billion in 2023 to 1.217 ringgit billion, while net income dropped from 25.02 million to 18.78 million. This shows reduced profitability, likely due to higher operating or financing costs. For assets and liabilities, total assets slightly decreased from 901.27 million to 893.53 million. Current assets, however, increased from 514.17 million to 561.85 million, improving short-term liquidity. Total liabilities also fell from 357.57 million to 285.43 million, showing better debt management and lower financial risk. For equity, cash, and borrowings, total equity rose from 543 ringgit.73 million to 548 ringgit.11 million, reflecting retained earnings despite lower profits. Cash and bank balances increased from 93 ringgit.72 million to 70 ringgit.07 million, indicating stronger liquidity. Total borrowings decreased, showing less reliance on debt, while receivables grew, signaling good credit management. Overall assessment in summary, Senheng maintained financial stability in 2024 despite lower revenue and net income. Improved liquidity, reduced liabilities, and higher cash levels reflect a cautious balance sheet focused strategy, positioning the company well for future growth.
Okay, for the next part, which is from Mr. DIY, for the data collection, I will present the breakdown of data collection for Mr. DIY. Like I have said for the beginning, which is focus on financial performance for 2 years, 2023 and 2024. Purpose of this table to compare Mr. DIY financial performance over 2 years. It helps us examine change in asset, liability, equity, revenue, and so on, and also provide organized data for financial ratio analysis. First, for asset, total asset increased from 3.5 million in 2023 to RM 3.8 million in 2024. This growth indicate business expansion and a strong asset base. Total asset also increased, which show improvement in the company's short-term financial position. Inventory level remain relatively stable, suggesting efficient stock management. In addition, cash and bank balance increased significantly, reflecting stronger liquidity and better cash management by the company. For the next, which is liability, we look at liability. Total liability increased from 1.8 million in 2023. Current liability rose marginally, indicate that short-term debt still well controlled. Even that trade and other receivable, which is such as higher salary activity, it also reflects higher credit exposure. On the positive note, borrowing decreased from 11,000 to 10,000, show that Mr. Dewa reduced reliance on debt financing. For the next, which is moving to the equity. Total equity increased from 1.7 million in 2023 to 1.9 million in 2024. This growth was mainly driven by higher retained earnings, which indicate improved profitability. Overall, the increase reflects stronger shareholder value and financial stability. Revenue and profitability. Now let's discuss about the revenue and profitability. Revenue increased from 4.3 million to 4.6 million performance in 2024. At the same time, net income from 5,600 to 5,600,000, which reflect improved profitability and effective cost management. Overall financial performance, overall, I can say Mr. D will demonstrate positive financial growth from 2023 to 2024. This can be seen through strong asset growth, improved liquidity, increased revenue and net income, and as well lower borrowing, well management, and management ability. In conclusion, Mr. shows stable and profitable financial performance. The company demonstrate effective financial management and strong growth strategy, making a solid performance in the retail sector. Thank you.
Now, I will present the financial performance of Senheng New Retail Berhad for 2023 and 2024. We will look at revenue, profitability, assets, liabilities, equity, cash, and borrowings to understand the company's financial health. For revenue and profitability, in 2024, Senheng's revenue declined from 1.315 ringgit billion in 2023 to 1.217 ringgit billion, while net income dropped from 25.02 million to 18.78 million. This shows reduced profitability, likely due to higher operating or financing costs. For assets and liabilities, total assets slightly decreased from 901.27 million to 893.53 million. Current assets, however, increased from 514.17 million to 561.85 million, improving short-term liquidity. Total liabilities also fell from 357.57 million to 285.43 million, showing better debt management and lower financial risk. For equity, cash, and borrowings, total equity rose from 543 ringgit.70 million to 548 ringgit.11 million, reflecting retained earnings despite lower profits. Cash and bank balances increased from 93 ringgit.72 million to 70 ringgit.07 million, indicating stronger liquidity. Total borrowings decreased, showing less reliance on debt, while receivables grew, signaling good credit management. Overall assessment, in summary, Senheng maintained financial stability in 2024 despite lower revenue and net income. Improved liquidity, reduced liabilities, and higher cash levels reflect a cautious balance sheet focused strategy, positioning the company well for future growth.
For a ratio analysis, we have 5 key elements. First is liquidity, second is profitability, third is efficiency, fourth is solvency, and last one is market ratio. So we go to a liquidity. The current ratio, to find the current ratio, we have used a formula, current asset divide current liabilities. So we go to a company Senheng. For 2023, we get 2.10 times, and 2034 we get 2.58 times. After that, we calculation the Mr. DIY. For Mr. DIY, we get 1.69 times, and 2034 we get 5.98. To get the formula quick ratio, use current asset minus inventories divide current liabilities. Okay, we go to a Senheng. For 2023, we get 0.82 times. For 2024, we get 1.12 times. For Mr. DIY, we get 0.54 times. For 2024, we get 0.68 times. Profitability, we have 5 sub-elements. We got to first one is a gross profit margin. For a gross profit margin, to use a formula, we use a gross profit divide sales. For a Senheng, we get for 2023, we get 21.06%. After that, 2024, we get 21.10%. We go to Mr. DIY. As you can see, we get a 45.36%. For 2024, we got a 45.85%. After that, we go to operation profit margin. For the use formula operation profit margin, we use a two formula, which is EBIT and OPM. For EBIT, we use gross profit plus other operating income minus operating and admin expenses. After that, we use operating profit margin, which is EBIT divide sales. Go to the Senheng company, which is for 2023. After we calculation for EBIT, we get a RM 3.3 million. After that, we divide for sale. The value is 1.3 million multiple 100, and we get 2.52%. Same goes to 2024. Use a same formula. We get 0.17%. After that, we go to Mr. DIY. We get 0.19%. 2024, we get a 0.18% net profit margin. For a formula, net profit margin is net income divide sales. Go to the company Senheng company. For 2023, ROA we get 2.74%. For 2024, for ROA is 1.29%. We go to Mr. DIY. For 2023, we get a ROA 15.79%. For 2024, we get a ROA is 14.94%. We go to a return of equity. For return of equity, we use a two formula, which is a shareholder equity. To get a shareholder equity, we use a total asset minus total liabilities. After that, we get a net profit divide shareholder equity. So we go to 2023, which is a Senheng company. Before we calculation for ROE, we use a formula shareholder equity. After we get a calculation of shareholder equity, we use a ROE formula, and we get a 4.6%. After that, 2024, we get a 2.02%. For 2023, Mr. DIY, so we got for ROE 32.13%, and 2024, we get a ROE 29.30%. Return of asset. Return of asset use a formula net profit divide total asset. We go to the company Senheng company. For 2023, ROA we get 2.74%. For 2024, for ROA is 1.29%. We go to Mr. DIY. For 2023, we get a ROA 15.79%. For 2024, we get a ROA is 14.94%. We go to the efficiency, which is a 5 sub-element key. So we go, the first is inventory turnover. So we get a two formula to get an inventory turnover. For a Senheng company, 2023, we get for inventory turnover is 3.82 times. After that, 2024, we get 3.53 times. And then we go to Mr. DIY. For 2023, we get 2.15 times. After that, 2024, we get 3.82 times. After that, we go to the average collection period and total asset turnover. We use a formula that average account receivable divide revenue multiple 365 days. So we look at 2023 for a Senheng company. We get 9.35 days. After that, 2024, we get 8.005 days. For Mr. DIY 2023, we get 7.11 days. And then 2024, we get 8.45 days. Alright, we go to total asset turnover. For a total asset turnover, we use a two formula, which is average total asset. Average total asset is total asset begin year plus total asset end year divide 2. After that, we use average total asset. After we get a total asset, average total asset, sale divide average total asset. Okay, for a 2023, for a Senheng company, we get a TAT 1.49 times. For 2024, we get 1.38 times. For Mr. DIY 2023, we get 1.327 times. After that, 2024, we get 1.26 times. For fixed asset turnover, we use two formula, which is average fixed asset and then FAT, or fixed asset turnover. For Senheng company, 2023 we get FAT is 6.52 times. After that, 2024 we get 92 times, and then Mr. DIY we get 11.40 times. After that, 2024 we get 9.65 times. So the last one of our efficiency is account receivable turnover. So the formula of account receivable turnover, we use two formula, which is average account receivable, ART, which for a company Senheng 2023 we get ART is 43.47 times, and then 2024 we get 40.22 times. After that we go to Mr. DIY, which is 2023 we get 9.52 times, and the last one is 2024 is ART is 48.30 times.
So the next ratio was solvency ratio. There's two categories for this ratio. The first one was debt to equity ratio. As we can see, at the year of 2023, the Senheng ratio was 0.65. For Mr. DIY is 1.03. At the year of 2024, the ratio for Senheng is 0.52. For Mr. DIY is 0.96. The next ratio was debt to assets ratio. At the year of 2023, the ratio for Senheng was 0.40. For Mr. DIY, it's 0.51. At the year of 2024, the ratio for Senheng was 0.32. For Mr. DIY is 0.49. So the last ratio was the market ratio. There's four categories for this ratio. So the first ratio was the earning per share, also we call EPS. At the year of 2023, the EPS for Senheng is 1.67 cent. For Mr. DIY is 5.94 cent. At the year of 2024, the EPS for Senheng is 0.74 cent. For Mr. DIY is 6.02 cent. Move to the next one is the dividend per share. We also call it DPS. At the year of 2023, DPS for Senheng was 0.70. For Mr. DIY is 2.80 cent. At the year of 2024, the DPS for Senheng is 0.22 cent. For Mr. DIY is 5 cent. After that is the dividend payout ratio, also we call it DPR. At the year of 2023, the DPR for Senheng is 49.1%. For Mr. DIY is 47.1%. At the year of 2024, the DPR for Senheng is 29.7%. For Mr. DIY is 83.1%. So the last one is price earning ratio, also we call PER. The PER for Senheng at the year of 2023 is 26.9. For Mr. DIY is 25.3. The year of 2024, PER for Senheng is 45.9. For Mr. DIY is 26.6.
Moving on to liquidity ratios, this ratio measures a company's ability to meet its short-term financial obligation. From the analysis, Mr. DIY demonstrates stronger liquidity than Senheng. This means Mr. DIY is better able to settle current liabilities using its current assets. On the other hand, Senheng lowers liquidity indicates limited short-term financial flexibility, which may affect its ability to manage unexpected expenses. Next, we look at the profitability ratios, which measure how well a company generates profit from its operation. Based on the analysis, Mr. DIY record high gross operating and net profit margins compared to Senheng in both years. This indicates cost control and an effective profit strategy by Mr. DIY. In contrast, Senheng lower profit margins are mainly due to higher operating costs, intense competition, and lower margins in the electronic industries. Furthermore, Mr. DIY higher ROE and ROA show more efficient use of equity and assets compared to Senheng. Next, we examine the efficiency ratios, which assess how effectively a company uses its asset in daily operations. Mr. DIY show higher efficiency, particularly in its inventory turnover ratio. This suggests fast-moving inventory and strong daily demand for its product. In comparison, Senheng exhibits lower efficiency ratio, mainly due to slower inventory turnover, as electrical products are generally higher in price compared to Mr. DIY consumer goods. Now, let us look at the solvency ratios, which measure a company's ability to meet its long-term financial obligation. Mr. DIY shows an improvement in its capital structure, making it less exposed to financial risk through effective use of both debt and equity. In contrast, Senheng relies heavily on debt to finance its operation, which increases its long-term financial risk. Finally, we look at the market ratio, which reflect market perception and investor confidence. We see that our price earning ratio remains stable across both tiers, indicating consistent and positive market sentiment. However, the sharp increase in Senheng price earning in 2024 suggests overly high market expectation despite the company's weaker financial performance.
For this section, I will present the findings and recommendation based on the financial comparison between Senheng Avenue Retail Berhad and Mr. DIY Group and Berhad for the years 2023 and 2024. Overall, Mr. DIY performs better than Senheng across more financial ratios. In terms of liquidity, Mr. DIY shows a stronger ability to meet short-term obligations, while Senheng shows some improvement in 2024 but remains relatively weaker. Looking at profitability, Mr. DIY consistently records higher gross operating and net profit margins as well as stronger returns on assets and equity, indicating effective cost control and efficient operation. In terms of efficiency, Mr. DIY has a higher inventory turnover, showing faster sales and better demand. From a solvency perspective, Mr. DIY has a lower long-term debt level, which indicates lower financial risk compared to Senheng. Market performance also reflects stronger investor confidence in Mr. DIY, supported by its more stable price-earning ratio, while Senheng market performance is weaker due to declining profitability. Based on these findings, Mr. DIY is recommended as stronger company, while Senheng needs to improve its profitability and efficiency and financial stability to enhance future performance. The conclusion of our financial performance comparison between Senheng Retail Berhad and Mr. DIY Group and Berhad for the financial years 2023 and 2024. Our analysis focused on key financial ratios covering liquidity, profitability, efficiency, solvency, and market performance to assess the overall financial health of both companies. The findings indicate that Mr. DIY consistently outperforms Senheng. It demonstrates higher profitability with better returns on assets and equity, stronger liquidity, and more efficient use of its resources. Mr. DIY also has higher inventory turnover and a stronger capital structure, meaning it can manage both short-term obligation and long-term financial risks more effectively. On the other hand, Senheng has shown some improvement in liquidity and debt reduction, but its profitability has been declining. This suggests that while Senheng is improving its financial stability, it still faces challenges in generating higher revenues and profits. In conclusion, Mr. DIY Group's and Berhad is the stronger company and a safer choice for investor thanks to its consistent performance, effective asset management, and financial strength. Meanwhile, Senheng must focus on enhancing profit margin and overall productivity to strengthen its position in the competitive retail market. And that's all from us. Thank you.